my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. There are some obvious differences here that I have been at pains to point out compared to the Chicago contract, notably the absence of a suitable bump and run reversal top trend line anywhere below the market, such as we've seen in Chicago. Interestingly here, the extended fall from the double top back in late May halted initially at the rising long moving average, currently 611, and then after changeover at the December 2020 to date uptrend, currently at 590, before moving back up last week. There was also no weekly key reversal here last week, but just as Chicago, we are on for a monthly key reversal here in July. If we close over 659 or under 620, then we'd be on. Right now, well, the market is barely looking at a monthly key reversal up and is awfully close to making an outside month. It all depends on where we close next Friday, the 30th. In the meantime, the ideas I had for either a bearish halfway hesitation or a double bottom, well, they are no longer valid here, and I've retired them. However, I would reprise one part of my commentary from last time, and I quote, "This market is far less along the road of contemplating a move lower. We're not there yet in this contract," end of quote. It looks like we'll have to give it some more time to see what patterns can be revealed here. Minneapolis wheat. I've got to say again, you've got to admire this contract. I have repeated this now for a number of weeks, months now, that there are, once again, a number of, let's be honest, huge differences here in this contract compared to Chicago and the Kansas City contracts. Well, for starters, and perhaps supremely important, the August to December 2020 bullish Andrews picture, which has run this market higher so successfully since the end of last year, was still valid as recently as the end of last week. It was then that the market really punched up and out of the upper time, which is unusual compared to the others, up and out of the upper time, currently at 892. Now, prices tried to move higher, but the failure to form a key reversal up this past Monday, instead of opting for the lesser outside day, followed by a bearish engulfing pattern, which was part of a two-day pipe top, well, soon enough we were back within the bullish Andrews pitchfork, the same one. However, this is not all. As this move allowed me to draw a more acute April to May bullish Andrews pitchfork, this second one growing out of the first, and we found ourselves in between the lower time, currently 848, and the middle time, currently 942, of this new bullish Andrews pitchfork. Support is below at the 2017 high at 868, and topside, well, we have resistance at 937 and 957, but I'd look at the 50% absolute Fibonacci level at 974 to be the next real topside resistance. It all now depends on whether the pipe top that was formed this week is a strong pipe top or whether it is a interim measure on the way up. As much as I've been saying for weeks, months now, the bullish incentive is still alive and well here. Until this bullish Andrews, or these bullish Andrews pitchforks guiding this market, are broken, then they will continue to show the bullish angle of attack. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.